Welcome to our channel, where we unlock paths to wealth and success. Let's grow rich together. Imagine this. You're sitting at your desk, watching the 10-year U.S. Treasury yield soar to nearly 4.8%, a level not seen in over a decade. For some, this feels like spotting gold in a crowded market, an unbeatable chance to secure high returns. For others, it's a glaring red flag, signaling potential trouble ahead. So, which is it? A rare opportunity to invest, or a market trap waiting to spring? Let's untangle the web of data, policy, and human behavior shaping the Treasury market today. The dramatic rise in 10-year Treasury yields, from just 1.5% in 2020 to nearly 4.8% in early 2025, has left bond prices tumbling. While some investors wonder if yields are peaking, others brace for further declines. Here's why caution might be warranted in the short term. Federal Reserve policy, a relentless hawk. In 2024, the Federal Reserve launched one of its most aggressive rate hiking cycles in decades, raising rates to 5.25% to 5.50% to tame inflation. While December 2024's CPI showed some progress, inflation slowed to 3.8%. Fed Chair Jerome Powell has made it clear, rates won't come down until inflation is firmly near 2%. Imagine inflation flaring back up due to rising wages or energy prices. Powell's hawkish stance means the Fed could keep rates elevated for longer, putting continued pressure on bond prices. For short-term traders, this is a storm cloud that refuses to clear. Trump's return and fiscal policy. As Donald Trump steps back into the White House in January 2025, fiscal expansion looms large. Proposals for sweeping tax cuts and infrastructure spending could balloon the federal deficit, which already exceeds $33 trillion. Increased Treasury issuance to finance these policies might push yields even higher, further weighing on prices. For bondholders, this creates a short-term squeeze. More supply, but less certainty about demand. Investor uncertainty is at a peak. Bond volatility indices like the MOVE Index show heightened nervousness, as traders grapple with whether the market has truly hit bottom. Historical precedent suggests that stabilization takes time, especially when fears of additional rate hikes linger. While short-term risks dominate the conversation, there's another side to the story. The long-term appeal of treasuries as a cornerstone investment. Here's why they still matter. Yields near 4.8% are rare. For comparison, similar levels in 2007 preceded significant price rebounds as the Fed slashed rates during the global financial crisis. For long-term investors, locking in today's high yields could mean steady income for years. Real-life example. A pension fund manager sees today's yields as a golden opportunity to ensure stable payouts for retirees, unaffected by short-term noise. Treasuries as a safety net US. Treasuries are more than just bonds. They're lifelines. With near-zero default risk, they remain a go-to for risk-averse investors. Why it matters? Whether it's a financial crisis or geopolitical tension, treasuries historically attract capital in uncertain times. They're not just investments, they're insurance policies. As inflation cools and economic growth slows, the Federal Reserve will eventually pivot to rate cuts, potentially as early as late 2025. Historically, such shifts drive bond prices higher. Remember 2008? Yields plummeted, and bondholders reaped the rewards. Navigating the Treasury market requires balancing immediate challenges with potential long-term gains. Let's break this down into two key scenarios and strategies to address them. Number 1. If inflation remains stubborn, rising wages or energy prices could keep inflation elevated, forcing the Federal Reserve to maintain higher rates for longer. This would likely lead to further increases in yields, putting additional pressure on bond prices in the short term. Imagine a scenario where oil prices spike unexpectedly. The ripple effect could boost transportation costs, reignite inflation, and make the Fed more cautious about cutting rates. For bondholders, this means more short-term price volatility. Number 2. If economic growth slows. On the other hand, if fiscal tightening or global uncertainties weaken the economy, the Fed might pivot sooner than expected. Rate cuts would drive yields down and bond prices up, providing significant capital appreciation for investors who locked in higher yields earlier. Picture this. A slowdown in consumer spending leads to weaker corporate profits, signaling economic fragility. The Fed, aiming to stimulate growth, announces its first rate cut. Such a move would likely boost demand for long-term treasuries, rewarding patient investors. Actionable strategies. For short-term investors, focus on short-duration bonds or treasury ETFs like SHY, 1 to 3 year treasuries. These instruments are less sensitive to interest rate changes, offering stability amid market uncertainty. For long-term investors, consider gradually building a position in long-duration treasuries, such as TLT, 20-plus year treasuries. By investing in smaller increments, you can take advantage of any further price declines while locking in today's high yields for future gains. Diversify your portfolio. Pair treasuries with equities, commodities, or other asset classes to balance risk. For instance, while bonds provide stability, equities could capture growth in a recovering economy. The treasury market today is a tale of two realities. Short-term risks, driven by persistent inflation, hawkish Fed policies, fiscal uncertainty, and shifting global dynamics, pose real challenges. But for investors willing to take the long view, high yields represent a rare chance to lock in stable returns and potential capital gains as the economy eventually cools. So, ask yourself, are you ready to weather the short-term storms for long-term rewards? With careful planning and a clear strategy, the U.S. Treasury market can still be a cornerstone of financial security in an unpredictable world.